All right, let's talk about something every investor is wondering right now. Are we all just buying into a massive bubble with our ETFs and index funds? The S&P 500 is sitting at an all-time high, and the media is screaming about overvalued stocks, inflated prices, and the looming crash. So, should you pull back, wait for the dip, and avoid buying into the market? Or are we just overthinking things? In today's video, we're going to break this down step by step, and by the end, you'll have the clarity you need to make smart decisions moving forward. Let's dive into the world of ETFs and index funds in 2025 and answer one of the most pressing questions in investing today. Are index investors just buying into a bubble? Section 1. The current market picture. So here's where we stand as we enter 2025. The S&P 500 is cruising past 6,000 points. That's a level we've never seen before. It's tempting to think this is the peak, the big bubble everyone warns you about. Cue the doom and gloom music. And don't get me wrong, the numbers don't lie. The S&P 500 has posted incredible returns recently, 26% in 2023 and 25% in 2024. And now investors are asking, at these levels, is the market too hot? Should we be worried? Here's the thing, we've been in this kind of situation before and it's not always as bad as it seems. So let's dig a little deeper. Section 2. The value debate. One of the big metrics people are watching is the Shiller PE ratio. Right now, it's sitting at 38, the second highest in history. Historically, it averages around 17. Ouch. Yeah, the market's looking pretty expensive. But here's the catch. High valuations don't always mean a crash is coming. Here's an example. Remember 2016? Experts were warning the market was too expensive, and many advised pulling out or waiting for correction. But if you had listened to that fear and sold, well, you would have missed out on a solid decade of growth. So what does that tell us? Section 3. Fear versus statistics. Now, this brings us to a very important question. Should we be trying to time the market? I don't know a single person who's been successful at timing the market. And trust me, I've been around the block. Heck, even Warren Buffett himself says he has no idea where the market will go in the short term. But here's the thing. That uncertainty can actually work in your favor if you're a long-term investor. The key is sticking to your strategy. Section 4. The power of dollar cost averaging. Let's talk strategy. The one that's been a game changer for so many investors. Dollar cost averaging. This strategy is simple yet so effective. You invest a set amount of money regularly, say $1,000 each month, into a diversified ETF, no matter where the market is. It doesn't matter if the market is high or low, because over time, your money buys fewer shares when prices are high and more shares when prices drop. And here's the kicker. Studies show that this strategy actually outperforms most active stock pickers, time and time again. In fact, only 15% of actively managed funds have outperformed the S&P 500 over the last decade. So if you're doing dollar cost averaging, you're already beating the odds. Section 5. The 2007 example. Timing doesn't work. Let's take a look at history. Picture this. It's October 2007. The stock market is at all-time highs, and people are worried about the upcoming global financial crisis. Now, what if you stuck to your dollar cost averaging plan and just kept investing $1,000 every quarter? What would have happened? Surprisingly, you would have been ahead of the game by 2010, even if you started right before the crash. That's the power of sticking to your strategy through thick and thin. The market always recovers, eventually. Section 6. The ETF debate. Are they all created equal? Okay, so now that we've addressed the timing issue and the power of dollar cost averaging, let's talk about ETFs, because not all ETFs are created equal. Sure, an S&P 500 ETF is a great way to passively track the market's performance. But lately, there's been a surge of thematic ETFs, ones that track sectors like tech, healthcare, or even cryptocurrencies like Bitcoin. While these might sound tempting, they're not the same as the low-cost, broad market tracking ETFs we're used to. These thematic ETFs are riskier. They focus on specific sectors or trends, so if that sector underperforms, you're in trouble. That's a more active strategy, and if you're here for passive investing, this might not be the right choice. Section 7. Final thoughts. Should you buy ETFs in 2025? So, to answer the question, are index investors just buying into a bubble in 2025? The truth is, nobody really knows. The market is unpredictable in the short term, but If you're a long-term investor who sticks to a strategy like dollar cost averaging and focuses on broad market ETFs, the chances are you'll come out ahead. The market has always had its ups and downs, but over time it trends upward. And if you're investing for the long haul, you don't need to worry about timing the market. You just need to stay consistent. If you enjoyed today's video, hit that like button and subscribe to the channel. I'd love to hear your thoughts on ETFs and dollar cost averaging. Are you worried about the current market, or are you sticking to your long-term plan? Let me know in the comments below and share this video with someone who might be questioning whether they should invest in ETFs in 2025. Let's have a conversation. Thanks for watching, and remember, investing is a marathon, not a sprint. I'll see you in the next one.